Chinese stocks, particularly technology companies, have been in the spotlight in 2021. The recent crackdown by the Chinese government has led to a stock market crash on the Hang Seng Index, falling more than 20% from its highs in February. The government introduced sweeping legislation to limit monopolistic conditions, unequal distribution of wealth and opportunity, and what it deemed to be vices plaguing the people of China and their youth, such as online gaming and gambling. With very little warning, the government effectively nationalized the after-school private education industry, banning profit-generating operations for education of children up to a certain age. One stock in response, TAL Education Group, has fallen 95% from its high in February of this year. All of this sweeping reform is part of the government's plan to achieve common prosperity and lift much of the Chinese population out of poverty and into the ever-growing middle class. Some of the most popular and successful Chinese companies have had billions of dollars of market cap wiped off their value in a matter of months, including the likes of Tencent with minus 40%, Alibaba minus 50%, JD.com minus 30%, and Baidu minus 38%, to name a few. You might think that many look like bargains, especially relative to their US counterparts, which trade at earnings multiples significantly higher. A value investor might be tempted to invest in Chinese companies to gain from their rebound and go past their all-time highs once again. After all, these companies are revenue behemoths, some of which have incredible balance sheets and billions of dollars of cash flow per year. You may have even noticed that you can invest in these companies on the US stock exchanges. Simple, right? Well, unfortunately, it's not. This video will discuss the American Depositary Receipt, or ADR, and what you as an investor are actually investing in when you purchase shares in an ADR. You might think by doing this, you are owning a share of the company, its assets, liabilities, profits, and so on by becoming a shareholder, and it's a reasonable assumption to make. Under normal circumstances, that's exactly what you would be doing. But that is not the case with ADRs, and it's particularly risky to invest in these when it comes to Chinese companies. So without further ado, let's get into the video. To start this off, we have to highlight that foreign ownership in certain Chinese industries is prohibited. The wording is vague, meaning that this applies to most companies, and as a result, it's illegal for Chinese companies, like the ones mentioned earlier, to have any non-Chinese shareholders. Meaning, if you are not Chinese, you cannot invest in the Hong Kong listed technology stocks, among others. To bypass this Chinese law, a legal structure was used called the VIE, the Variable Interest Entity. This wasn't developed specifically for this Chinese law and was actually around for years before, coming into the spotlight in the US when Enron used it to manipulate assets and liabilities on its balance sheet. That alone should be the first warning. It's the VIE structure that gives these Chinese companies access to foreign capital while also allowing non-Chinese investors access to these companies. To explain how this works without getting too complex, let's use Alibaba as an example. Alibaba operates in a sector on the restricted list issued by the government, so Alibaba cannot sell shares to non-Chinese investors. But using the VIE structure, we can buy shares in Alibaba. What happens is, Alibaba will create a shell company offshore, typically in the Cayman Islands, which is also called Alibaba. We will refer to this as Cayman Alibaba, and the original company just as Alibaba. Once Cayman Alibaba has been set up, the Chinese company can consolidate the shell company into its group through complex legal structures and fees to make it look like Cayman Alibaba can lay claim to any of the assets or profits that Alibaba makes. What's important here is that there is no real ownership of these assets by Cayman Alibaba. Once this is done, Cayman Alibaba lists on the New York Stock Exchange, where foreign investors can buy shares in the company under the name Alibaba. The shell company appears to lay claim to the assets and profits, when in reality it's just a shell company in the Cayman Islands with no real assets or business. This is not specific to Alibaba. Every single ADR you see on the US stock markets for Chinese companies uses the VIE structure. Now you might say, what's wrong with that? There are ADRs for UK companies on the US stock market too, such as AstraZeneca and BAE Systems. The difference with Chinese ADRs is that the VIE structure is illegal under Chinese law. The reason being is that under Chinese law, it states that any contract that intends to avoid a law, this one being the foreign ownership of restricted equities, is not enforceable. So the idea that Cayman Alibaba, the one listed on the New York Stock Exchange, has any claim to the assets and profits of the real Alibaba is null and void under Chinese law. This was really highlighted when Jack Ma, founder and CEO of Alibaba, unilaterally transferred ownership of Alipay, China's largest payment processing company, into a different company owned solely by himself, effectively stealing the company from international investors. One of the largest investors was Yahoo, who owned a 43% stake in the business. But because of the VIE structure, Yahoo and other shareholders had no power to do anything, which ultimately led to the CEO of Yahoo being fired. They didn't own 43% of the actual business. They owned 43% of Cayman Alibaba, the shell company that was set up. Once again, this is nothing new and has been around for many years. The Chinese government seemed to have turned a blind eye to it in the past, as after all, it provides their country with significant investment needed to achieve their goals and ambitions. The point being is that few investors know what they are actually investing in when purchasing shares of ADRs, whether they are retail or institutional. They do not represent the ownership of real assets like other stocks do, and this poses significant risks to your capital. Uncertainty around this has been amplified in recent months, as the government has rolled out sweeping regulatory crackdowns, seemingly overnight in some cases, and should China decide to suddenly enforce its laws, investors could be caught out with material losses, or even get left with nothing. If geopolitical tensions between the US and China continue to escalate, the most extreme outcome could be for China to declare VIEs illegal and therefore worthless, wiping trillions of dollars from international shareholders invested in these ADRs. As we've seen with the regulatory crackdowns already, China does not seem bothered at wiping out significant levels of capital from their own equity markets. While I think this is unlikely to happen, I do not think institutions do enough to alert investors of these risks when marketing their funds. As a retail investor, it's important to do your due diligence on a potential investment before allocating your capital. I'm not saying you should not invest in these companies. They are great companies that have generated value for many over the years, but you should know the risks of your investment. Coupling this with the targeted regulation we have seen this year, some famous investors, such as Cathie Wood and others, have dumped most of their Chinese stocks for fear of further regulatory measures. Others have gone as far to deem China uninvestable until the situation becomes clearer. Some, on the other hand, feel that much of these risks have already been priced in. Investors such as Manish Pabrai, Al Gore, and Charlie Munger have made significant investments in Alibaba, clearly seeing a value opportunity to invest in China's largest e-commerce platform. Having identified the risks associated with ADRs, I will analyze a potential Chinese stock investment to see if I think there is value to be had in the market, or avoiding these altogether is best, so be sure to keep an eye out for that in the future. If you got value out of this video, make sure to give it a like down below and consider subscribing to Wise Wealth for more personal finance and investing content. Thanks for watching, and until next time, see ya.